Good afternoon, everybody. Thanks to all for being with us today. Welcome to this webinar on banking for sustainable and inclusive infrastructure. This webinar has been organized by the Istituto Internazionale in collaboration with the Banca Intesa San Paolo, and it's one of the several meetings and roundtables which the Institute is organizing in the framework of the T20. For those who are not familiar with this acronym, the T20 is one of the engagement groups that supports the activities of the G20. It's a bank for ideas meant to provide policy recommendations to the G20, and the Istituto Internazionale has been appointed by the Italian government as one of the two co-chairs of this year T20. Now, first of all, I would like to thank Ugo Doyle and Banca Intesa San Paolo for their support, for their collaboration. I would also like to welcome and thank Antonella Baldino, Chief International Development Finance Officer of Cassa Depositi Prestiti. And I would like to thank her because she has accepted to open our webinar with a keynote speech. I don't know whether Gelsomina Rigliotti is already with us, but I'd like to thank Gelsomina, Director for International Financial Relations at the Ministry of Economy and Finance. I would like to thank, of course, all the panelists who will be with us this afternoon. And last but not least, Franco Passacantando, scientific advisor at the Istituto, who will moderate our proceedings. The objective of today's webinar is to contribute to the current debate on how to promote private investment in sustainable and inclusive infrastructure. The webinar is also the objective to discuss policy recommendations addressed to the G20 through a dialogue between representatives of key stakeholders, the T20 on one side, but also the B20, Business 20, and the D20, the Long-Term Investors Club, which is another engagement group that supports the activities of the G20. Very briefly, a few remarks to open our discussions. The COVID-19 is having a very strong impact across and within countries, partly because it has accelerated existing trends, partly because it has reversed existing trends, but it has also added a number of new challenges. The economic consequence of COVID have increased the need for substantial infrastructure investment to support global recovery. And the COVID emergency has also shown that recovery should be focused, must be focused on building a more inclusive and sustainable future. This is a mantra which we repeat on all possible occasions. Now, investing in infrastructure can provide an important stimulus for economic growth. Few figures to give you an idea. It is estimated at a 1% a GDP increase in public investment in advanced economies and emerging markets has a potential to increase GDP in the long run by 2.7% and to generate a surge in private investment of about 10% and to create between 20 to 30 million jobs, directly, of course, and indirectly. Adequate public infrastructures, that should include also social infrastructure, such as schools or hospitals, are also crucial in combating the negative effects of the external shocks of the pandemic. In addition, investments to build or to renew public infrastructures can provide a vital stimulus for economic recovery. As recognized by the United Nations in the list of the Sustainable Development Goals, well-functioning and resilient infrastructure are the foundations of every successful community and are as well a prerequisite to achieve a fair and sustainable long-term growth. However, according to the Global Infrastructure Outlook, a G20 initiative, which again supports the proceedings of the G20, the gap between the current trends and needed infrastructure investment in the coming 20 years amounts to something like 15 trillion US dollars, equivalent to 0.55% of world GDP. So there is a need to boost investments, in particular private investment in this field. Renovation of existing infrastructure, investment in new projects, and long-term management and maintenance require significant financial resources, both public and private. So public investment, both from governments and international institutions, are essential, but given the exceptional constraints and strain on public finances generated by the recent crisis, with the enormous increase in the level of public debt accumulated by almost all countries in the world, participation of the private sector is necessary even more. And there are, nevertheless, several barriers that undermine private investment participation in sustainable and inclusive infrastructure. This is the task for the G20. The task is to improve an enabling environment to stimulate private investment. I stop here. I only would like to add one last consideration, is that I sincerely hope that the discussion of this afternoon will provide some useful ideas on how to improve the environment for private investment in sustainable infrastructure. Thank you again to all, and now I give the floor to Ugo Doyle for his introductory remarks. Ugo, the floor is yours.
Thank you, Ferdinando. Thank you for your introductory remarks and for your kind words. As you stated, Intesa Sanpaolo and Istituto Affari Internazionali have developed, I would say, some 4 years ago, this strategic partnership focused on studying the relationship of mutual influence, if we can call it that, between the financial and the policy-making world. We call it a Geo Financial Partnership. And the objective is to collaborate, combining the study of policy-making balances in different constituencies, in different geographies, with the study of financial evolution, the governance that defines its framework, and the regulations that make things happen and make them enforceable. Of course, identifying the relationships of double causality that bind these two areas, finance and policymaking. Our latest event was back in April with the presentation of what I think was a very timely and interesting volume, the volume called The Near Future of Central Bank Digital Currencies, produced by the Institute in collaboration with Banca d'Italia and Intesa Sanpaolo. Coming to today's event, I wish to thank the Institute for this kind of invitation, for this opportunity, and in particular our good friends Ferdinando Nelli Feroci, the president of the Institute, Franco Passacantando, Fabrizio Botti, and Nicola Bilotta, who are always very focused with new ideas, and it's difficult to keep up, but it's definitely healthy. So thank you again. So I would like to frame my opening remarks also as a member of the coordinating group of the B20, B for Business. B20 Italy has various task forces. The task force I've been involved with is the Finance and Infrastructure Task Force, whose chair is our CEO, Carlo Messina. And this task force has finalized its policy recommendations to the G20. The paper is currently embargoed, but I don't think I'm committing any specific sin if I say that financial inclusion, sustainability, sustainable infrastructure are heavily quoted in the paper itself. And while these themes are relevant in themselves, they are clearly additionally relevant in the current phase of COVID emergence, or exit from COVID, hopefully. We think and hope that even though with many hiccups, we are tailing off out of this nightmarish situation with a possible recovery phase in sight. Now, while we all hope that we are at the beginning of the recovery, it's clear to many, at least, that this recovery needs to be sustainable and inclusive. But let me just go for 1 second to the concept of sustainability and share with you what I think it means and whether it comes with costs, because everyone is speaking about sustainability. The costs of sustainability are maybe not an item that is frequently discussed. Now, sustainability has come to the attention of actionable policy making, if we can call it that, in the recent past. But of course, it's been with us for a long time. And I think one of the most effective definitions of sustainability is the one that the Nobel Prize winner Bob Solow, who is famous for many quips, came up with. And let me read it in order to get it proper. Sustainability as the societal outcomes that allow future generations to be at least as well off as people are today. Now, while in economics, in banking, we focus a lot on a concept of sustainability, which is the financial dimension of sustainability. I think that talking about sustainable infrastructures as we are today, a very tangible real economy concept, looking at a material infrastructure, of course. I think there is a concept of technological sustainability that we should definitely consider, especially when we look at technologies that might trigger what sometimes we call a paradigm shift. Let me exemplify what I'm trying to say in more empirical ways. We are currently, or many constituencies, many geographies are, for instance, looking at hydrogen as energy source that has the advantages of availability and the clear advantage of being environmentally virtuous. And to do that, to have hydrogen available across the board, one has to consider a very thorough, very pervasive laying out of a grid line across geographies, where you can simply tap this source of energy. Now, to do that, one has to come up with very sizable investments that have a clear financial sustainability component. But of course, there is, before and even more upstream than a financial sustainability component, there is a technological sustainability question that needs to be addressed. Let me just clarify one thing. Mine are not rhetorical questions. These are just questions. And I don't have an implicit answer. I'm just saying that on a technological front, one would need to put yourself into the framework of answering the question, do we know whether this technology, this grid line, which will cost mint, will be what we need in 20, 30 years' time down the road in terms of green technologies, or will there be stranded costs that are not friends with the concept of sustainability, which will remain there in the horizon? So I think today we're talking about sustainable infrastructure. The concept of technological sustainability, to me, is one of the crucial ones that needs to be addressed. Again, it's not a rhetorical question. I wish I had even a partial answer to these points, but I feel that it's definitely a clear point to focus upon, and maybe some inputs will be made available today by our distinguished panelists. But let me just go back to the current discussion and just remark how governments are, of course, in their effort to walk out of the coronavirus recession, they're targeting very huge rises in expenditure across the board in many sectors that are clearly linked to the concept of sustainability. I think the financial industry has been in the front line of the crisis, but should and will be in the front line in terms of the answers to how to get out of it. And this has also been highlighted recently by a very important report by the Basel Committee that came out, I would say, some 10 days ago or so, called Early Lessons from the COVID-19 pandemic on the Basel reforms. And this report combined with the workings of the Financial Stability Board and what the G20 is producing will be the platform and the focus of the Bank of International Settlement will be the platform to give the degrees of freedom to the banking sector and the financial sector at large to be part of the solution for the recovery. Now, briefly, as I mentioned, I am not at leisure to anticipate the specificities of our B20 work, but I just wanted to say that while public investment will surely be at the front line, as we're seeing also in Italy, of recovery, I think that the days of crowding out of the public sector to the detriment of private investment flows are behind us, are well gone, and the name of the game, I think, will be very much so PPP co-investments in sustainable infrastructure, the promotion of smart infrastructure in various fields from environmental and economic sustainability perspectives, remote healthcare, smart mobility. These are all areas where we think and look forward to collaborate with we as finance actors, sector representatives. We look forward to collaborate with the policymakers in a context where the days of crowding out, I think, are well behind us. Of course, I think that all these aspects will be made way more actionable if sustainable infrastructure becomes an asset class of itself. I don't want to anticipate, as I mentioned, our conclusions in our policy-making paper, but these features, the taxonomies associated with asset classes on sustainable infrastructure will be clear, will be crucial. As will be clear also the need of having reporting standards and implementation standards that are compatible with the incentives of all the actors involved. So I think that asset class specific to sustainable infrastructure will be definitely a way to give meaning to a PPP collaboration between actors on both sides of the spectrum. Now, of course, the sectorial application of these PPPs is very vast, but exemplifying with things that are dear to the heart of also Intesa Sanpaolo, we think that there's a lot of potential, a lot of opportunity in urban and suburban regeneration investments, also with the aim of effectively increasing infrastructure resilience. So these were my 2 pence worth of wisdom. I thank you again for the kind invitation on behalf of Intesa Sanpaolo. I want to thank my friends and our friends at the Institute, and I look forward to future collaborations and to today's debate. Thank you.
Thank you very much, Ugo, for your considerations, very useful also for our debate on this afternoon. And I now give the floor to Antonella Baldino.
Thank you, and good evening, to you all. Let me begin by thanking President Feroci and Mr. Doyle for the invitation to participate in today's event on banking for sustainable and inclusive infrastructure, and also for your introductory remark. And I also would like to say that I'm very pleased to be part of this event with Franco Passacantando, moderator of the roundtable, who not only for CDP, but I would say for the whole system of development finance institution, is the right person, the reference point in the debate related to the European development finance architecture. So I'm delighted to have this opportunity to provide the perspective of Cassa Depositi e Prestiti, or CDP, the Italian National Promotional Institution, which was established in 1850 with the aim of fostering the development of our country using national savings responsibly. And it's in its 170-year history, CDP has consolidated a unique role in the Italian economy with a growing international sphere of operation, supporting sustainable growth and placing at the core of its strategy the development of strategic infrastructure for a more inclusive and resilient economy, both as lender and as an equity investor. A role that is today even more relevant in the aftermath of the pandemic. Indeed, global demand for infrastructure has actually increased, as shown by the recovery plan of the different countries. Infrastructure will represent the backbone for the recovery in the global economies. It will be a challenge to finance this development, but it will be an even greater challenge to finance it in the right way. There is currently a widespread consensus on the projection highlighting that a large component of future emission of greenhouse gas will originate in infrastructure which are still to be constructed. Therefore, if we want to achieve the Paris climate targets, we must fully commit now to the sustainability of future infrastructure. We all agree that sustainability infrastructure is critical, and we all know that huge investments are required to implement a suitable investment program. A simple number to reflect on, in accordance with the G20 Global Infrastructure Hub, the global infrastructure gap is estimated at around $640 billion yearly until 2040, and as we all know, public resources appear to be overwhelmingly insufficient to cope with this need. This is a critical challenge. However, at the same time, we do have to recognize the opportunity provided today by the private sector. Private investors show high level of resources available for infrastructure projects. The infrastructure industry at global level had assets under management at the end of 2020 at $639 billion. At the same time, we cannot ignore the level of the so-called dry powder, meaning resources raised but not yet invested, which, to give you an idea of its entity, reach about $222 billion in 2019. This record levels clearly shows that infrastructure projects are an appealing asset class, and the still large investment gap signals that private investors have an untapped potential for challenging new resources to the sector. So in order to cope with this growing demand for infrastructure and the significant amount of untapped resources, it became imperative to improve the attractiveness of infrastructure investment and to maximize private capital, leveraging on 4 strategic pillars. First of all, enhancing tools for supporting government in the planning, development, and financing of infrastructure programs. Secondly, promoting a strategic and quality infrastructure projects, then easing internal and cross-border regulatory barriers to infrastructure investments, and also introducing suitable risk mitigation mechanism. And lastly, fostering the realization of projects that integrates element of sustainability in properly assessing investment risk and returns. In light of this, CDP has consolidated a specific business model aimed at unlocking the required investment in infrastructure with particular focus on sustainability and resilience. We are traditionally a long-term investor, able to provide patient capital to the real economy through specific tailor-made financial instruments. And in our view, being a long-term investor is not only limited to deploying patient capital, but is also related to the ability of looking strategically ahead towards more distant horizon, focusing on the long-term impact of our promotional activities. In our experience, an effective strategy for sustainable, inclusive infrastructure should be designed in order to create a bridge between public and private interventions, between the public interest and private capital risk appetite, to create a vehicle to strike the right balance between public intervention and the market rules. On one hand, the private sector should play a central role in designing cutting-edge but financially viable projects, whilst on the other hand, donors, promotional banks must be traditionally concentrated on allocating resources effectively in order to mitigate non-marketable risk to finance these projects. This is the core mechanism of blended finance, mixing different financial resources to maximize the leverage effect of limited public funds by crowding in private capital, attracting long-term investors, converging upon effective sustainable development. Indeed, blended finance is the crucial factor for establishing a suitable connection between public and private sector to plan, finance, and execute the well-designed infrastructural interventions to effectively support a sustainable recovery. And in this sense, greater recourse to the public-private partnership, or PPP, is essential. The PPP approach is part of our core DNA and a business model as national promotional institution. Indeed, CDP in itself is an extraordinary example of PPP, a vehicle that for 170 years has proactively employed the private savings from postal accounts to deliver public investments for sustainable growth. At global level, we share our DNA with other relevant financial institutions active on the international stage, in particular public development banks that, like CDP, with their public mandate, combined with the market-oriented approach, represent crucial players in bridging the gap between the private investors and the public institution, and are ideally placed to create strategic partnership to develop the right condition for sustainable and inclusive infrastructure to be implemented. Strategic partnerships that are even more necessary in a sector such as infrastructure, which requires a strong convergence of intents between all stakeholders involved, government, companies, public and private financial institutions, a convergence of intents to create a favorable environment and to develop a flexible and effective financial instrument to support infrastructure programs. With this vision in mind, the Finance in Common coalition took shape in November last year, a movement of all public development banks united in the aim of reinforcing the international financial architecture and increasing and redirecting global financial flows towards the achievement of the UN 2030 agenda and the Paris Agreement target. Of course, sustainable infrastructure represents one of the key topics addressed by the coalition, as we all recognize their critical role in enabling a just transition to a smarter and low-carbon economy, and more generally in stimulating the recovery as well as shaping more inclusive, sustainable, and resilient societies. These issues were proactively addressed within last November Finance in Common Summit, convening for the first time more than 450 public development banks active worldwide and their key stakeholders to define a common roadmap to further foster and accelerate the transition to sustainable finance. So building upon the positive results of last year, a second edition of the Financing Common was scheduled, and it will be CDP pleasure to host the second summit next autumn in Rome under the auspices of the G20 Italian presidency. The 2021 Financing Common will be an important opportunity to consolidate the public development bank's commitments launched last year and to reinforce the partnership among these institutions and their stakeholders on the most topical issues in the international debates, such as the financing of sustainable infrastructures, establishing a fruitful connection with the G20 agenda. Indeed, over time, the G20 has been a catalyst in the wider global debate on infrastructure. Today, public development banks on a national, regional, and multilateral scale aim at reinforcing the collaboration on an agenda to promote infrastructure as an asset class and the key role of quality, sustainability, and inclusiveness within this agenda. Reflecting the same purpose, a major event will take place in Rome in September, promoted by the D20 Long-Term Investor Club, with CDP playing an active role as this year's host institution. The club, which has among its members most of the biggest G20 national development institutions, aim to promote a debate on the best way to unlock private capital in infrastructure and to align it with long-term growth and development goals. So to conclude, the D20 event and moreover the Financing Common Summit will represent a unique opportunity to highlight once again the Public Development Bank's crucial role as the financial hub for the implementation of the international commitments taken by the government multilaterally. And I can say that CDP stands more than ready to play a central role, an active role in financing sustainable and inclusive infrastructure by promoting a constructive partnership among the G20 shareholders, public development banks, and other relevant actors, and in joining forces with banking for sustainable inclusive infrastructure to tackle today's challenge for both the next generation and the next one. So thank you for your attention.
Let me thank once more Antonella Baldino for her intervention, a wide illustration of the role played by CDP and other national development financial institutions. Franco, the floor is yours.
Yes, thank you, Ferdinando. Thank you, Antonella, for this introductory perspective of a difficult task that we have ahead of us, which is how to combine the private sector banks with public objectives of sustainability and inclusiveness. And you clearly explained how long-term deposit institutions like CDP can play a key role in this. But today, now we will have a roundtable of very, very distinguished scholars who will give us a further insight into this problem. And we are lucky to have a very diversified group of scholars and experts and professionals from different parts of the world and different backgrounds. So I think I will slightly change the order of the presentation. I would like to first give the floor to, let me present, the order I had in mind. The first would be Rim Ayadi, who is the president of the European Mediterranean Economist Association and professor at the CAS Business School. I will then like to hear from Ottaviano Canuto, who is a senior fellow at the Policy Center for the New South and a long background in multilateral development banks, including the World Bank and other important responsibility. Then, since we are talking about banking for sustainable, we will need a banker. And so we will have Tommaso Nicola Armento from Intesa San Paolo, who is a senior corporate banker of industry and real estate partners. So he will give us the perspective of the private bank. Then we will have Cynthia Pastor, who is the director of a very important hub, that is the Economics Global Infrastructure Hub. And I would also like to hear her views. And finally, John Seed, who is the head of Sustainable Infrastructure Policy Unit of the European Bank for Reconstruction and Development. We agreed to have a first round of intervention of about 7 minutes, which will be followed by a second round and questions by the other panelists, and then we will open the floor to the audience. So let me start with Rim Ayadi, who has been actively involved in the T20 and has worked on a policy brief which has analyzed and developed a number of policy proposals on how to mobilize banking for infrastructure, for sustainable and inclusive infrastructure. So Rim, why don't you start? The floor is yours.
Good afternoon, everybody. Thank you very much, Franco. And I would like to thank the III for inviting me to this event. So I have prepared a few minutes comment on this specific, very important topic, which really is also linked to the fact that the COVID-19 pandemic, and has already been said, has uncovered the level of infrastructure and preparedness worldwide, particularly in the social sector, which is the healthcare sector, while also highlighting a very important fact that there is a clear widespread concern about there is an increasing debt vulnerability and unsustainability in both developed and emerging economies. So practically speaking, we are in a juncture where the private sector money is needed to enhance and strengthen the infrastructure development for the years to come. Now, the need for investment and new financing schemes in public infrastructure, including the social infrastructure, is very critical, particularly in countries where they were completely caught unprepared to deal with the health emergency that we've seen in particularly in low and middle income countries. And this is why I want to focus on my intervention. Now, for example, if we look at Africa, the distribution of certain vaccines and medical equipment was not even possible because of the lack of essential infrastructure, particularly in remote areas. Now, today, there is a clear opportunity to fundamentally review the priorities of different types of infrastructures and the respective roles of the public and private sectors and how they can partner in investing and financing infrastructure, while also strengthening the governance frameworks via enhanced transparency of debt issuance, also contracting, and the use of the funds that are being borrowed by countries. And this is all to achieve the goal to further tap the capital market to fulfill the financing needs for infrastructure development. And this is why I would like to really focus is how to ensure we could untap the appetite of the capital market to invest and to become a sustainable investor in this field, in this infrastructure development. Now, in our paper on sustainable and quality infrastructure beyond COVID-19 pandemic, proposal for new financing models that you mentioned, with other colleagues from the Asian Development Bank Institute, we made very specific proposals and recommendations, and hopefully this paper will be published and you can access to it. But in what follows in my intervention, I would like to focus on one specific proposal, which is part of another paper that it's to be published this week, is to enhance private-public partnership financing for infrastructure development, particularly in low and middle income countries, in which the private sector, such as banks, also private investors, can take part can take part and also fund some of the risks of this type of these transactions. So as it is widely known, the project finance bonds are very costly, particularly in these type of countries, the low and middle income countries. And for this reason, they have not really become a big market. So it's a very tiny, small market, which is almost not existent. Now, relying on the international development banks and countries only funding has proven to be not enough to fulfill or fill the gap in infrastructure development. So we need to, as I mentioned, tap the private sector and capital markets. So our proposal for financing infrastructure development via the private-public partnership is to decouple the sovereign risk and execution risk from the typical project finance bond, using also guarantees and co-guarantees structures from international donors or eventually World Bank or other type of development banks. Now, this PPP financing for infrastructure development will be a market instrument that can kickstart a market for PPP financing for infrastructure development, and that when fulfilling certain conditions can be even qualified as sustainable, green, inclusive, resilient, whatever have you. But the main point here is to decouple the both sovereign risk and execution risk. Now, the sovereign risk, it's normally assumed by a country benefiting from the infrastructure development via, for example, a sovereign guarantee that could also be co-guaranteed by International Development Bank, World Bank, or a member of the World Bank Group. This has happened, for example, in Ghana. But this risk or the debt should be first of all registered on a global debt registry as part of a firm requirement of debt transparency and a clear acceptance of the possibility to monitor the use of funds for infrastructure development. Now, again, debt transparency is a pillar for effective monitoring of the use of funds and also standardization of contracts in general. Now, the second part, which is the execution risk, should be externalized and managed via a standardized framework, which we call it, or we frame it as a ready for audit framework. So this execution risk generally is assumed by the developer or the executor, but then after a very strict procurement and DD assessment, so the due diligence assessment. Now, the funds that are raised or supposed to be raised by the capital market or from the capital market are strictly escrowed in SPVs, special purpose vehicle funds, that only accessible for a predetermined cost breakdown and based on work done. This is very important, and they must be monitored quarterly by a reputable, independent, top-notch audit and management firm under also very strict conditions of the fund management agreement, what we call it the fund management agreement. Now you might ask me, what happens if there is no performance of the executor? Yes, there is a possibility, and this is why a predetermined prompt corrective action should be implemented, of course agreed in advance, and then implemented after a systematic consultation with the project stakeholders, including the governments themselves, acting as sovereign guarantor, and whoever is acting as a co-guarantor, okay? Now, in case of performance, the executor or the developer should be paid in a portion of the margins up to 50% in deferred consideration. So you keep the incentives aligned. So then you give him incentive, you give these companies the incentives to finalize the job. Now, all this information on the project execution, cost monitoring, and everything should be included in the prospectus of the bond upfront. So the investors are aware of it, and then they understand what is the risk that they are taking. So in a way, you decouple the sovereign risk and the execution risk. Everything is clear upfront. And then obviously this will provide, of course, we put some conditions for this financing structure to be viable. And then you could also add some indicators, for example, to assess greenhouse emissions, level of inclusion, contribution to local employment, and any other indicators you want to have. But what is important here, and I will close my remarks here, this financial structure has the following benefits. Number one, it will lower probability of default, risk premium, and recovery rate in general, okay, and enhance predictability for the investors, so private sector, including banks and others, and it will reduce also the reputational risk. Number two, it will reduce the corruption because everything is predetermined in advance, and operational risk. And three, it will increase the certainty of execution while aligning to the right incentives, and at the same time, enhance the consultation with the relevant stakeholders involved in the PPP financing mechanism. So we have 5 conditions for this structure to function. Number one, transparency, debt transparency. Number two, promoter or developer or whoever is doing the work has to be very carefully DD'd, so due diligence, and margins should not be front-loaded. This is extremely important. So they have to accept 50% of the margins deferred whenever the work is done. And then obviously the project has to go through the normal value for money assessment. Also the margins must be publicly disclosed upfront. And then there is, of course, an important role for an independent audit and management firm from the start of the process. And finally, the prompt corrective action in case of material risk in the execution phase, assessed independently by the auditor or the management firm that is assigned. I would stop here. Thank you.
Thank you, Reem, for this very interesting introduction. I mean, it's the T20 often presents itself as a bank of ideas, and so your presentations really is in tune with this mission of a T20 as a bank of ideas, and certainly your ideas are of great interest. I think the idea of the issue of how to allocate the risks between public and private and between different stakeholders and how to align incentives is the key issue that we are facing. And that brings, as you said, leads to the issue of how to have a relationship between multilateral development banks or international institutions and individual actors or nationals, and also how to provide the standardization across the spectrum and then let differences. So a lot of problems, a lot of issues. I hope there will be a follow-up on all these. So let me now turn the floor to Ottaviano. Ottaviano, who has also worked on a policy brief on this issue. And again, Ottaviano, if you can tell us the main conclusions that you have reached and the main proposals, again, for this bank of ideas that we are trying to create.
Thank you. Thank you very much, Franco, and good day, everybody. And thank you also to IAI to have us here. As Franco has said, some of us at the Policy Center for the New South, together with Professor Miguel Vasquez from Bocconi University, we've been working on a note to the T20 on this topic, trying to bring particularly an angle to the case of Africa. And very much in convergence with the lines that Reem has also said, and also of all the other speakers, the major issue is to build bridges, convenient bridges, so as to expand the presence of the private financing to infrastructure projects. And in fact, some data recently released by the Institute of International Finance show that over the past 15 years, the institutional investors with long-time profiles in their assets, such as pension funds, have been gradually increasing their allocations to infrastructure investments and alternatives to fixed income instruments, equity and other traditional instruments, which have not offered appropriate yields for their commitments. Because the stable and long-term returns from infrastructure projects don't do well with the long-term commitments of those financial institutions, particularly, as well said before, in a context of declining long-term real interest rates on public and private bonds, like those of recent decades in advanced countries. And this is not likely to change very much. Now, in turn, the surveys carried out by Prekin and reported by the IIF also show that fund managers are already pointing to decarbonization of energy, for instance, as a factor in attracting private investments in infrastructure. So to add to our discussion here, maybe just touch on 2 points that we bring with respect to the biggest challenge in extending those bridges. And particularly in the case of non-advanced economies, because as has been fully acknowledged, at the margin, the needs are particularly high in the case of non-advanced economies, now and in the future ahead. And let me focus on the 2 tasks that we think, as we present in the note, as required to be fulfilled in order to have the objective that we're talking about today. First, besides the development of the properly structured projects with risks and returns in line with the preferences of the different types of financial intermediation, that would help to close the private financing gap in infrastructure. As Rim aptly described and touched upon, you have several layers and different kinds of risks. And while the universe of financial institutions, individually, they feel more comfortable or less comfortable in dealing with that or not with the other kind of risks. So in order to build to have the building, we need to have a allocation or let's say, covering some specific risks that are not, let's say, comfortably managed by the private sector. And that to be provided either by directly the remaining small fiscal space available to governments, but also to institutions, to develop national development banks and multilateral development banks. If we have mapping out the configuration of risks and different stakeholders along the project phase, defining exactly, differentiating the risk associated derived from execution, sovereign risks, and so on, we may have, let's say, if filling the blanks, we make possible the presence of insurers and other types of private agents, and so to get the objective, having the infrastructure investment up and running. We should keep in mind that in each and every survey made with potential private investors, they very often cite the absence of complementary instruments or investors as one of the identified causes of failure in the financial completion of projects. So the idea is exactly to look at the taxonomy of instruments and vehicles for infrastructure financing, mapping out in each case what might be filled by financial institutions and what should not otherwise be complemented, filled by multilateral institutions and or national development banks and so on. So we need to have, in order to have the pipeline, we need to have at project levels this identification and the mapping of the whole tissue of presence of private and semi-public agents in order to make possible the completion. But there is also, obviously, and follows from that, the second task, which is the reduction of legal, regulatory, and political risks. Rim aptly remarked the relevance of transparency. We should add as well the need to have some harmonization of rules and standards so as to increase the scale of comparable projects and make it possible to build project portfolios. Again, non-banking financial institutions often highlight the absence of ample project portfolios as a disincentive for setting up business lines focused on the area. And this is obviously a particularly weak point in the case of smaller countries. So in a nutshell, we have tightness of fiscal space relative to investment needs, particularly in the case of developing non-advanced economies. We have a mismatch between the availability of low-cost finance and the scarcity of infrastructure investments. We have the need to have crowding in of private investments rather than crowding them out by official financing of projects. We have a profile of risks along project stage and the mismatch between risks and comfort to manage them. We have a heterogeneity of project standards and regulatory frameworks, which runs against building pipelines that would be necessary to boost infrastructure investments in emerging markets and developing economies as an asset class. And of course, green and sustainable and inclusive investments in infrastructure would constitute special pipelines of that. And of course, greening infrastructure in non-advanced economies would benefit from being able to attract greenbacks into the business. Thank you.
Thank you, Ottaviano. Again, you are stressing the key issues of how to allocate different risks and the mapping of different risks is of crucial importance. You reminded us that there are several also private actors. There are banks, there are insurance, there are different funds. So how to allocate risk among all these actors is very important. And second, an issue that I know you have been working, and we have been working when we were together at the World Bank, the issue of harmonization, because sometimes, very often, the issue of the complexities for the investors of different legal regimes in each country is one of the impediment to investments. So thank you for reminding us that. And so I think we can now continue our discussion. And as I mentioned, it's time to hear a banker. Tommaso Nicola Armento, who is a senior corporate banker from Intesa Sanpaolo, please give us your perspective on these issues. Thank you.
So thanks everyone for the possibility to be here. I'll try to be, most of the concepts that I will say, of course, are part of the broader conversation. And unfortunately, I'm not having invented new to create an easy solution. But it's important to give the banking perspective as well to this point, because I think it's interesting to see how every actor see the overall picture to grab his contribution. So I think we can say that the use of public partnerships, public-private partnership has been done to build everything as of now, from parking garage to airports, and is an increasingly popular finance mechanism of sustainable infrastructure for governments that are increasingly strapped for cash. Private sectors collectively have the resource to do a lot of things. We know sustainability and ESG are now key to topic to develop institutional capital. We are seeing that some investors are not even considering investing in shares. So you can imagine how hard it is to get money into projects. But why are they not doing enough of it, given the dire need of returns that savings are facing since the zero interest environment began? I mean, we know that there's not really many alternatives to invest. Let's bring over the response for later, and let's have a look at what's going on. Maintenance and repairing, i.e. keeping the existing capital investors, is unquestionably something continuing to be happening by and large. And actually, in Italy, we had a very unfortunate example of what maintenance means, or not doing exactly that. By way of example, a lot of the fiscal problem of the Southern Europe came because of the spending they devoted to new infrastructure in the last decade did not equally translated into additional revenue stream, meaning by building a new infrastructure, you are creating a nice opportunity for the economy to develop. But the question remains the same for private capital. Has the sustainable infrastructure said to be necessary, so the greenfield, a solid source of revenues that pays back itself? Well, if the answer is no, it doesn't mean that you don't have to do it. The problem is, again, has the public entity or the entity that is planning to do it enough resources and a plan to enable it? because resources are not just that. Spain toll roads is an example of things that went wrong and just left there with a very bad thing for the investors. If we have a look at where the money are spent, we can see that a lot of the money, this is the 4 years observation from Information News, it is a data provider that we normally use for this kind of analysis. We can see that greenfields have a very small piece of the cake. Most of the money goes to refinancing an existing infrastructure. So this, of course, is the overall value of assets, but it can give you a snapshot on where the money flow. Now, if we move on and see what kind of money do we have, here we have an angle. We took some data from Refinitiv, which is a very important data provider, and just having a look for the UK funds, so to limit the area of investment of how much money are flowing into this sector. We can see the last 4 years, including COVID, UK infrastructure funds jump according to Refinitiv investors and are selecting more and more infrastructure investment that meet certain standard related to sustainability, environmental and social government criteria. Now, if we can see, since 2007, there has been a growing presence of infrastructure fund and investor. They started just interacting with corporate, basically buying the asset they want to sell, and then slowly, now they can mobilize huge capital in very short time frames and work alongside, if they want, in pursuing the best financial strategy, so acting as friend to the corporate for the project under discussion, but at the same time, they also can be direct actor of the context. So with their own corporate platform with manager, they can also win public auction and develop greenfield. So what is the lesson learned? What we have seen this year? I mean, new infrastructure are enabled for growing economy to go faster and improve quality of life, remove bottlenecks and inequality. But there is a need to create more investment-ready, sustainable projects to let the money flow consistently into the system. What we can say is that the true game changer will be to turning sustainable infrastructure into a tradable asset class, which immediately let everybody understand what is the thing we are talking about and immediately put into a pocket, immediately understanding for the board what it is that. As of today, while many companies engage in sustainable business practices, there is not like a gold standard of what defines sustainable infrastructure. There exist many different standards in terms of global networks for sustainability, such as the Equator Principle, the Green Investment Principle, and the Blue Dot Network Principle. But the standardization of that, it's what I think we are needing for creating a real trend of investment that should be easily classified. So working on standardization of contract terms that creates some disclosure harmonization together with clear mechanisms that create costs for deviations, avoiding basically greenwashing mechanism that many people are talking about green, but it's not really green or sustainable. It's just a fancy idea of having it. And ideas can be common clauses, contractual building blocks that can be used in a modular way to fit into contracts that are otherwise bespoke, given the heterogeneous nature of sustainable infrastructure, countries involved, parties. And at the same time, incentivize the relative value of sustainable infrastructure by asset class, implementing specific regular return mechanisms to enhance their relative returns. We have seen the infra-supporting factors, helping banks releasing part of the RWA, assisting these investments in infrastructure. Why don't thinking about something that is tied directly to sustainability and ESG? The asset class is and will remain complex, and it won't be easy. From our experience, we have worked globally, all over the place, and Australia is totally different from Africa, that is totally different from Europe, for various reasons, and not all the actors are playing in all markets. But the strong efforts that are being developed to clarify what is intended to be sustainable are key to put more private capital at work to it, because if you recognize immediately, you can immediately tell everybody what kind of thing you are trying to achieve. So thank you for the possibility to talk. I think I've finished my time.
Thank you, Tommaso, for starting with the question, why are private investors reluctant to invest, given that we are currently in a very, very low interest rate environment and there are not many interesting opportunities unless very speculative ones? And again, you stress the issue of standardization, which is becoming one of the leading message of this roundtable. I'm very pleased about that. And, you know, if the G20 has to play a role with respect to the G20, this is certainly an area where the G20 has to work and to clearly set some framework for harmonization and standardization, which of course has been working on, but has encountering many difficulties, as we all know. So now let me turn to Cynthia Pastor, who is as I said, the Director of Economics Global Infrastructure Hub, a very interesting organization. And again, what is the Global Infrastructure Hub, which I understand publishes a report every year, and what are the main issues the hub is working on, and what could be the experience, the understanding that is being developed in the hub be transmitted to the G20 through us. Please, Cynthia, welcome.
Good afternoon, Franco, and thank you for the invitation. I am very happy to be speaking in this roundtable. As you may know, the Global Infrastructure Hub, it's a non-for-profit organization that advances the delivery of sustainable, resilient, and inclusive infrastructure. Today, my intervention is going to be focused on the Hub's activities regarding improved private financing in infrastructure and promoting infrastructure as an asset class. So if we speak about like the global trends on infrastructure investments through the COVID crisis, we cannot deny that investment in infrastructure within the years has increased. But still, there is a significant infrastructure gap that limits the growth and the development. Everyone has already mentioned in 2017, the Global Infrastructure Hub Outlook report estimated a gap of $15 trillion to 2040. So the public sector is leading most of the total investment in infrastructure, but it is not enough to close this infrastructure gap. Investment from the private sector is also necessary, especially because a decrease of investment in infrastructure can be one of the first adjustments made when a country faces cyclical economic contractions. So while we have significant additional investment in infrastructure generated due to COVID stimulus, the current pandemic has weakened the fiscal position of governments around the globe, and sustaining the level of investment in the long term may be not possible. So again, the mobilization of private capital becomes therefore even more important. There are mixed messages when we analyze the private sector trends regarding investment in infrastructure. Our infrastructure monitor report of 2020 summarizes the final performance of infrastructure investment in order to build a road of infrastructure as an asset class. And there are some bad news and good news. First, the bad news is that if we look at the primary market, that is basically new infrastructure, the total private investment in infrastructure has not seen a level that is going to be able to fill that investment gap that we have. Within the years in the last decade, it's not increasing that much in real terms, and it's even decreasing as a share of the total investment. But there are also like better news. Some developing economies, especially Latin America and MENA, have been like the fastest growing regions for private investment, while Europe, on the other hand, has experienced a decline. In 2019, we found that the Asia Pacific region attracted the highest level of private investment, ahead of both Europe and North America. But despite these trends, high-income countries still attract most of the global private investment in infrastructure, around 80% in 2019. But those are promising trends now that we're seeing what I have mentioned. By sector, renewables was the one that attracted like the largest amount of private investment among infrastructure sectors, demonstrating the potential for great collaboration with the private sector on sustainable infrastructure. This was followed by transport and non-renewable power, with being like digital infrastructure has experienced significant increase due specifically the pandemic. So why are we seeing these trends? It's greenfield infrastructure not attractive enough for like the private sector? Well, not really. When we talk about financial performance of infrastructure equities, we have analyzed that they have an attractive risk-return profile. They provide a competitive alternative to other investment options. For example, over the last decade, despite listed infrastructure equities provided a lower average return compared to global equities, they did it with less volatility. And if we analyze unlisted infrastructure equities, they outperform the global equities with a 50% annual return with less volatility. And if we analyze financial performance related to debt, infrastructure debt, it's true that it has a higher risk of default at the beginning compared to other assets during the initial construction period, but eventually it stabilizes and performs as investment grade, in contrast to other type of asset classes, which typically experience like a steady rise in default over time. Particularly, infrastructure loans on average perform like an investment grade security by year 10 in high income countries and by year 14 in middle and low income countries. And even this is faster for PPPs. So over the last 20 years, or in a period of 20 years, infrastructure debt has shown a cumulative default rate of 5% for high income countries and 7% for middle low income countries. This compared to a 12% cumulative default rate of, if we consider like the lowest investment grade security, that is a Baa3, it has 12%. So definitely that the default rate from infrastructure, it's less. Additionally, infrastructure project finance has a recovery rate around 80%. So given the characteristics of the infrastructure sector, private domestic savings channeled through the institutional investors could be an ideal source to finance infrastructure. So far, their participation is increasing, but it's restrained as there are several limitations that prevent them from investing in greenfield infrastructure and being an attractive asset class. Among them, I would cite like the lack of pipeline of projects, the risk of construction within infrastructure, and the regulations that reduce liquidity to those sectors. What can we do to reverse these trends? There are several reasons why this is happening, and it depends on the context and the regions. In 2018, the G20 Eminent Persons Group developed recommendations specifically focused on removing roadblocks to infrastructures as an asset class. Also in the hub, last year, we started to explore one key recommendation for differentiated regulatory capital treatment of infrastructure investment. A second aspect is related to ESGs and sustainable infrastructure, which also starts to have some recognition in regulatory frameworks. While investors seek for good financial returns, infrastructure investors are increasingly incorporating sustainable elements in their investment strategies. This has driven a high demand for investment vehicles incorporating ESG topics. The widespread recognition by investors of the importance of ESG principles to screen potential investments and assess their long-term strategy has strengthened even with the pandemic. So currently, we are updating on our analysis regarding private investment in infrastructure and the financial performance, and we are expanding this analysis to try to evidence a positive correlation between infrastructure performance and incorporating the ESG criteria. these considerations need to be better integrated within the planning and the designing and procurement of infrastructure projects, while regulations need to incentivize private investment in much needed sustainable infrastructure specifically. And I will stop there. Thank you very much.
Thank you, Cynthia. Thank you for giving this information about the very interesting work that Global Infrastructure Hub has been doing. I was particularly struck by your indication that actually the default risk for investment infrastructure is not that high. So after having talked about risks, Fana, you tell us that yes, there is risk, but it's not as high as one could imagine. So these types of indications and numbers are of crucial importance. Of course, you also reminded us that the investments of private sector now go mostly to advanced economies and not to non-advanced economies where they are mostly needed. And we know that, of course, the risk is a crucial component of this. So, but it's the right time to hear from John, who has been, from his perspective at EBRD, has actually worked on a number of sustainable infrastructure projects, and will give us further indication, I guess, on what are the indicators that they follow to understand which projects are most attractive, and also recall also the issue of maintenance that we have been discussing, and the relationship between investment and infrastructure, because maintenance is often forgotten, while it is, as I think some of us mentioned, it is of crucial importance to make these investments really effective. So John, welcome, and the floor is yours.
Thank you very much, Franco. Good afternoon, everybody. Firstly, I'd just like to thank IAI for inviting me to take part in this esteemed event today. I've been asked to tell you a little bit about what EBRD is doing on the ground to promote green and sustainable infrastructure financing, and specifically about the role of indicators. And I'm also going to talk about digitalization and its role with sort of long-term asset lifecycle maintenance. EBRD has been investing in infrastructure across all different sectors since our first formation back in 1991. We currently invest around 4 billion euros a year in infrastructure across our 38 different countries of operation. We support the development and procurement of privately financed projects, as well as providing governments with upstream policy and infrastructure planning advice. But to give you an idea of the scale of our operations, in 2020, we supported 98 different infrastructure projects through either financing or the provision of project preparation support. So you can see, you know, infrastructure now regularly represents over a third of our annual banking investment, demonstrating that this is a really core part of our business. Now, the big news for us in 2020, coming into 2021, is that firstly, EBRD committed last year to be a majority green bank by 2025. That means that we need to increase our investment in green projects, what we deem to be green projects, by more than 50% of our annual investment by that date. We think this is achievable, as in recent years, we've grown this from 25% to 40%. So we're getting up to that 50% margin right now. So, you know, we're quite pleased about that. But the other big news for us is that EBRD will only invest in projects that are assessed as being 100% Paris Agreement aligned by the start of next year. So this means that we'll assess all infrastructure projects going forward for Paris Agreement alignment, whether the bank's investing in the projects or whether we're supporting procurement. And the EBRD board will only approve projects for investment that are deemed 100% aligned. And we've been working with other MDBs to understand what this might look like and how best to assess this, utilizing different sector-specific indicators. And this is another why indicators are so important to us. Hence, most MDBs are going to be adopting similar approaches to the one that we're developing right now. So in addition to the sort of the green economy transition and the Paris Agreement alignment objectives that we've got, we've also had, and following success of green bonds that we've launched, we're now looking at the development of sustainable infrastructure bonds. So we've also been working and supporting the Fast Infra initiative through participation in their working group 1. All of this highlights the importance of sustainability indicators, as we need these to judge whether project investments are green or sustainable and to what degree. The Fast Infra initiative recently recognized the importance of this from the outset, which is why they established their working group 1, which we're taking part in right now. And this working group 1 has developed a set of 14 different sustainability indicators that they're going to use to identify if projects over their life cycles are truly sustainable. But there's been significant criticism from large private sector institutional investors that the indicators that they're forced to apply on projects seem to be always changing from a project to project basis, and that different MDBs and other IOs promote different sustainability indicator sets. It's true that each MDB generally applies their own self-derived indicators, and this is in addition to many global indicator sets that are out there right now that have been developed and utilized over several years, such as the ones developed by BREEAM, by ISCA, by ISI, by GRES, by Global Infrastructure Basel, and that's just naming a few of these different sets. In addition to this global mix of indicator sets, the G20 Infrastructure Working Group is promoting the development and utilization of the quality infrastructure investment indicators. And the UN is now looking at considering developing their own sets of sustainability indicators. So consequently, it can clearly be understood why there's so much confusion and frustration from the infrastructure investors, given the different sustainability indicator sets in existence today. So to try to counter this, the MDBs came together in 2020 to undertake 2 new studies. These were each to compare the different indicator sets established and used by both the MDBs and the private sector organizations. Those with significant experience in the development and application of sustainability indicators speculated, however, at the outset that there could in fact be a significant degree of commonality between these sets. And hence, it was little surprise to us when we found that this was exactly the case. We found that something like 90% of the indicators, whilst they use different language and different terminology, they are fundamentally the same. This is intuitive because sustainability at its heart in infrastructure should be the same wherever you're practicing it and for whatever types of project. One of the 2 studies is now complete and the results are publicly available, and the second is going to be published very soon, so it's accessible to everybody. Both, however, basically show that despite the different languages being used to define the indicators and to measure these, the core requirements are the same across all the different indicator sets. The timing of this lesson was extremely important for the Fast Infra initiative, as rather than develop a completely new set of indicators for their sustainability certification, starting from scratch, they decided to use a commonly used indicator set that's out there right now. And they're basically using the IFC performance standards as their baseline indicator set to indicate green certification. So moving on to my second point, which is about digitalization. So cities is where there's an ever-growing majority of people in the world, where most people live. But they're also where there's most traffic, most industry, and where most commerce is located. So hence, this is where most greenhouse gas emissions in the world come from. So this makes cities, at the same time, the biggest contributor to the climate crisis, but also the biggest opportunity to solve it. So the EBRD Green Cities Programme promotes the development of infrastructure projects in cities that leads to energy efficiency improvements and greenhouse gas emissions reductions. Our programme today represents 2.9 billion euros of investment in infrastructure in green cities. And this leads to energy efficiency improvements and GHG emissions savings. This year, we managed to get up to 49 cities signed up, and we have a target of 100 cities by 2024. We added Ankara, Samarkand, Dnipro, and Istanbul this year. Smart cities infrastructure utilizes data to help governments to manage their infrastructure and services more effectively, to deliver a range of benefits to their citizens, including saving time, reducing costs, and improving energy efficiency. So operational improvements also reduce the energy needs, which reduces in turn the overall carbon emissions profile of digitized public services. So in short, digital enhancement of infrastructure in cities leads to better social, environmental and economic outcomes, making this a true catalyst for sustainability. And this is why EBRD has digitalization as one of our 3 core pillars of our strategy from now to 2025. However, it's believed, many commentators believe that over 90% of the infrastructure that we will need in the next 20 years has already been built and is in a poor state of repair. So a key area where we can make a significant impact is in respect to the development of digital enterprise asset management systems to help local, municipal, public and private sector clients optimize lifecycle performance of their infrastructure. So at EBRD, we're working to achieve the digital transition in infrastructure through including not only recommendations on how projects will benefit from different digital technologies, but also evaluating the maturity of the public sector at local level to fully adopt, operate and benefit from all these types of applications. So this ensures that any smart applications that are specified for new projects will truly benefit the public sector and the communities, helping to ensure the value for money will be achieved. So to finish, all in all, hopefully you'll see that the commitments that EBRD is making towards sustainability, green, decarbonisation and digitalisation are going to have a massive impact on infrastructure projects we finance and procure going forwards. Thank you very much.
Thank you, John. Thank you for reminding us of the importance of indicators. You know, it sounds like a very technical and not very exciting topic, but it is actually crucial for what we're talking about, which is creating an asset class and standardize, and that's crucial to attract private investors. I also appreciate your emphasis on what needs to be done at the level of cities, which are the main sources of the greenhouse gas emissions, which sometimes have difficulties in finding resources. This is, as you know, one of the key issues that is addressing the G20, the Italian G20. We already had a conference on this topic, and there will be another one, as I'm sure Gelsomina Vigliotti will mention in September, that will address specifically this issue. And finally, again, talking about non-exciting topics is the maintenance, because the maintenance sounds less exciting than the new ambitious project, but is as important. And of course, how digitalization can serve the maintenance, can help improve the maintenance. So we went a bit further than I thought, but I found it very, very interesting. So I didn't interrupt the speakers, but I think we can have 2 or 3 minutes of additional comments by each one of you, and then we will see if there are questions from the floor, and then we'll let Gelsomina present her final remarks. So who would like to break the ice and start? Ottaviano. Yes, let's use the standard old method of raising the hand instead of chatting.
It's literally raising the hand instead of putting the fist. Well, like you, Franco, I also appreciated very much the quality and the convergence of views and topics on what needs to be done in order to get the objective. I'm also very pleased to hear John when he observed that the issue of harmonization between among development banks is not such a big deal as much as sometimes some people think. I think that we need now to do a step further. In which sense? We need more available information of experiences on the lines that we have been touched upon. Why I'm saying this? Look, I myself, remembering from my times at the World Bank until 2 years ago, it comes to mind 3 successful experiences in blending private and development bank finance, using exactly the principles that have all been laid out in our presentations. It comes to mind the financing of an airport in Jordan. It comes to mind the successful project financed on telecommunications in Colombia. It comes to mind a series of water projects that the World Bank has been implementing, exactly pursuing that objective, that is to say, filling some gaps in terms of risk coverage and making possible therein the participation of the private sector. We need more information on this. John mentioned. So we hear that the multilateral institutions are all playing this ground. They are all trying to exactly to blend, to put together private and other forms of finance. We need to have those data available. Maybe a good important thing that the G20 might pursue, and the Global Infrastructure Hub, I understand, was also thought to be that kind of hub. A collection of different experiences and different examples, so that they would establish templates so as to show to the private sector, say, look, it's done, it's possible. Look at this myriad of projects following those principles and so on. So join in, make your investments in creating your capabilities to become a supporter of those projects. And also that would definitely give a good example for some countries and for some regions to develop templates and once we need some good examples when one shows that it's possible, and then all the other stakeholders, including countries, might have a stronger incentive to do their part in order to build up a database on infrastructure as an asset class, including the principles of greening. And as well highlighted at the very beginning by Annabella, the BIS and the institutions are working on some sort of classification of criteria to define what is greening and so on. So we need to go now to the step further, and the G20 leadership in pushing forward in that direction would be really a step further. Thank you.
Thank you, Ottaviano. Cynthia, I see your hand.
Thank you, Franco. Yes, I would like to support Ottaviano's message. We need to keep digging into data and advocating for infrastructure data development and management. This should be like a priority for our governments, especially we're talking about infrastructure, but we don't even have an estimation of how much countries are investing in total infrastructure that could be comparable among regions and among countries. And this is a difficult task. The hub, it's dealing with this, is trying to estimate. We have private investment, maybe the World Bank covers that within their PPI initiative. But then regarding public investment, it's hard to analyze or to have the number of how much governments are investing in infrastructure around the globe. One, I would like to talk about a little bit about an initiative that I know from the global Inter-American Development Bank. They have this database called InfraLatam, and they have made an effort to analyze public investment in infrastructure for the 26 countries or 22 countries that they have. And they have gone into the national accounts and analyzed account by account how much governments are specifically like executing in infrastructure. And that gives them the idea of how much their countries are investing. But this makes them also difficult to compare with developed countries or other regions because we don't have a number. There are estimates using like fixed gross capital formation, but this is an initiative that I would like to push, and it's very important to estimate and know from the start how much are we investing in infrastructure, because that puts us in perspective of how much we need and all the policies that come from that.
Thank you, Cynthia. Let me ask if Reem has
I would like to confirm what Ottaviano has mentioned about the data, the importance of data and collection of data. And we have started an initiative since last year to track all the debt transactions for particularly Africa, Middle East. And then also trying to do research and collect the data on the use of the funds, either for infrastructure development or for other type of uses, at least to understand what is the allocation of this debt into development projects in the countries. And I think this effort should be generalized in all countries. And later on, there could be some matching of the different initiatives. And this will help better understand the picture of this infrastructure investment and financing.
Thank you, Rim. I wonder whether Tommaso or John also have further thought, reaction to what the others mentioned. Let me start with John.
Yeah, I mean, I can only agree. I think the firstly I would say that the relating to what Ottaviano and Cynthia said. Firstly I would say that we've always cooperated and collaborated with Global Infrastructure Hub. They're doing a fantastic job of pulling together great case studies. On successful project financings in the past, in my past career, I've been involved in helping Global Infrastructure Hub develop standardized toolkits and guidance notes. And all I can say is that I don't think they're used enough. I think there's an awful lot of really superb work there that could be used more broadly and should be promoted more broadly by the G20. I think, however, on the issue of standardization, which has been mentioned, I would like to think that, in the role that we play within EBRD, we are really at the cutting edge of trying to help countries develop the critical infrastructure projects that they need. And, I've been involved in PFI and PPP procurement since 1998. So I've got an awful lot of war wounds in terms of doing private financing. Every new country and every new sector where we try doing PPP development, governments cannot help themselves but to try to reinvent the wheel or to reinvent the bicycle, as the French say. Despite the fact that you can bring years and years of experience of developing PPP programs from other countries, they cannot help themselves. They want to change the laws, they want to change the procurement documentations, they want to change the contracts. And this is an ongoing problem that we face in many countries. Right now, we have 18 renewable energy auctions that we're involved in. My team is involved in 18 renewable energy auctions. We've had some fantastic success this year in Kazakhstan and Albania, for instance. Yet when we try and take this model that we know works and works very well into neighboring countries, they always want to tweak it. So we have to recognize this problem. And what we try and do from a policy level is work with the governments closely on almost a personal basis to convince them about why you can't tweak these things, why these things are the way they are, and why they'll get best value out of that.
Thank you, John. I wonder whether Tommaso Armento.
I think one of the things that has not been said, but I would like to raise, is also the point that it's not just only the fault of the government itself. I think there are also some, economic perspective that big guys are hiding sometimes to keep things as they are and to keep going. I think most of the time, not everyone is moving in the right direction for economic reason. And unfortunately, most of the times is not that clear because the market is complex. But I think this is one of the aspects as well that is difficult to, elevate at the right level without creating clashes. But changing the mindset is not a matter of only of will, but also a matter of convenience. that has to be considered in my perspective. I see that we are trying to create situation, for instance, on our side, we are inserting key performance indicators specifically in contract to let people make a clear understanding of what we mean when we see ESG and sustainability in fact. But still there is a conveniency effect that is playing against the possibility to work in the right direction.
Thank you. Well, then let me, a couple of information. First of all, there are I received a number of hints of links to important reports and hubs, which we will make available for all of you, and as well as, some of the indications that emerged in the presentation that have been done in this presentation. There are also a number of, there are questions that are coming up from the panelists that would require further discussion. One from Rima Ayadi, which reminds us that one of the changes that often happen in these contracts is the changes in construction costs that are usually much higher and adds a further opacity to the process. Or what John said is suggested that variations in PPP contracts should be limited or constrained at a certain level of capex value, not to exceed this value. So these are a number of issues that can, of course, be addressed and have to be addressed. But given the time limits, I think we have to come to the final session of this seminar, and I'm very pleased to have Gelsomina Vigliotti, who is the Director General, International Financial Relations of the Department of the Treasury, and is heavily involved in the G20 of this year under the Italian presidency. And I hope, Gelsomina, that this discussion, you found it useful for the work you're doing with respect to the G20. So, Gelsomina, the floor is yours.
Thank you very much, Franco. Hope that you can hear me well. And thank you very much for this very interesting webinar. Actually, I would like, I take this opportunity also to thank very much the Istituto Affari Internazionali and the President Nelly Ferrucci, Professor Passacantando, for their assistance to our G20 presidency, and in particular on the topic of infrastructure. Actually, I had some notes for this conclusion, but actually after this very rich discussion, I hope that you will justify me if I will just react to what I listened, and I'll actually react to the very interesting issues that have been raised today. You know, infrastructure, as you all know, it's one of the major areas of involvement of the finance of the G20 finance track. Rightly so, because you know infrastructures are a crossroad of many important areas. Starting from, I would like to start from inclusion. You know, infrastructure are at the very basis to foster inclusion, to facilitate inclusion among people, among countries, among firms, among all the economic agents. They are at the crossroads of innovation, of technology. They are at the crossroad of finance, as we are discussing today. And actually, if I go through the priorities of the various presidencies, the G20 presidencies over the past few years, you know, I remember, for instance, Argentina developing the idea of infrastructure of an asset class, because actually we all recognize that, you know, there is a huge demand, a huge need of infrastructure all over the world. We need to mobilize resources. Public resources are not sufficient. But to mobilize, as we heard today, to mobilize the resources, actually we have to develop some features of the infrastructure so that investors are attracted and can invest their resources. Then we had the Japanese presidency with the emphasis on quality of infrastructure. Another very relevant topic, since actually what we saw over the past decades, that there was actually a huge increase of investment in investments, but sometimes they came without particular safeguards with respect to what we call today the ESG factors. And the Japanese presidency put a lot of emphasis on the quality features of infrastructure. And actually the Italian presidency, following the Saudi Arabia presidency, which had a much more focus on the technological sides of infrastructure, actually we want to follow on all these strands. Actually, we have the ambition to follow all these strands, and we have developed areas of work for inclusion. Actually, Franco mentioned at the very beginning the work that we are developing with the local authorities, and the idea is to look at the way in which the local authorities can actually, what is their involvement in the financing, in the developing of infrastructure. We will have an important event in Genoa at the end of September, and actually it will be an opportunity to discuss with the representative of the G20 and also with local authorities about what are the opportunities, the constraints, to push forward this agenda. Then there is all the issue, and actually let me talk now about maintenance, because I am at home and actually I'm maintaining my house. So if you will hear some noises, it will be because I'm maintaining my house. So maintenance, it's a very important topic that we had very high on the agenda this year, because actually it was one of the quality feature which was highlighted during the Japanese presidency. And actually we realized that having the maintenance issue at the core of the starting of a project is very, very much relevant, because in the end you have to cover the life cycle of an infrastructure. So when you start an investment for infrastructure, you have to provide all the resources which will be necessary to ensure that the whole life cycle of an infrastructure it's financed, so that there will be the necessary resources to maintain and to keep long the life of an infrastructure. That said, it's also very important, to look at maintenance also in terms of the sustainability, because if you want to provide the adequate financing for maintenance, this means that you can also safeguard all the sustainability factors behind and around the infrastructure. Other important issues that I heard today, and which are also very high on our agenda, is the issue of the standards of indicators. And maybe these are not very, as Franco said, it's very high political items, but they are very much important. And let me say that I think that in this area, the G20 contribution can be the most relevant one. We are talking about information, comparability of information, comparability of data, comparability of methodologies. And to me, I would gather all these under the the main area of the transparency of information. And this is a global public good to me. And in this regard, the G20 has a great responsibility to ensure that actually information data are available, that standards are developed, and that there are, indicators that can be used worldwide. I agree with John and others, and Tommaso also mentioned that there is plenty of exercise, plenty of initiatives that actually provide methodologies for standardization, database for project infrastructure. But in the end, what we need it's a global standard. And actually, looking at the success of the G20 in other areas different from infrastructure, I think that the major successes are in the definition of standards. And in this regard, I want also to to follow one of the points which was made at the very end of the conversation. We have a lot of geopolitics around this in the end. Actually, our experience in developing, in trying to push ahead the agenda of the standards of the transparency, actually there are many obstacles because in the end, we have national governments, we have a national regulations, we have national prerogatives. The access to data in the foreign investments are not always available. Getting this information, it's difficult. And behind that, I think that we need to progress also politically. And actually, we are very much interested in the issue of indicators and in the issue of developing worldwide standards. But in the end, actually, it will be very difficult to achieve a global standard, something which can be widely recognized. So working on an initiative which could be regional, which could be sectorial, it would be good. But, in the very end, I think that we should try to achieve some global standards. And in this regard, we will continue to push and trying to make some small steps in this regard by the end of this presidency. And I do not want to prolong too much my concluding remarks, but another areas where actually it's very important the progress that we want to look at for infrastructure is the sustainability issues, the green dimension of infrastructure. We all know that after the COVID-19, investment are necessary to boost the recovery. We know that infrastructure investment have a high multiplier. We know that green investment, there is empirical studies which show that they are job rich, they can create employment, and in this regard, we should put emphasis on sustaining, on promoting sustainable investment. In this regard, the issue of the comparability of data, the issue of the definition of what is sustainable and what is not sustainable becomes even more relevant. And in this regard, we are very proud as a G20 presidency to have again the Sustainable Finance Working Group, which actually will work on some of these issues, like for instance on the issue of the disclosure, on the issue of the taxonomies. There is a variety of exercises on the taxonomies, but having the opportunity to have it's a common agreement on what are the main taxonomy to look at, it would be very much important. To us, during this year as a G20 presidency, we had a wide range of events to outreach all the relevant stakeholders which are relevant for infrastructure. They have given us important contribution as the discussion, the webinar today. And I think that all these are opportunities which are very relevant to put together the academia, the international organization, the civil society, the private sector, which actually has an important role to play. And there have been important initiatives developed with the OECD, in particular the G20 Infrastructure Investors Dialogue, which was organized a few months ago in collaboration with the D20 Long-Term Investors Club. I want also to recall what Antonella said at the very beginning about the role and the importance of an initiative like Finance in Common, which will be held again by the end of the Italian presidency, will be very much important and can contribute to our agenda. I apologize if I didn't provide you with a more organized speech, but I prefer to react to your very interesting points which you raised, and actually I'm also very happy to recognize that the issue that you raised are actually the real issue that we want to focus on and to push on the agenda. Thank you to everyone. Thank you for the invitation. Franco, over to you.
Thank you very much, Gelsomina. I particularly appreciated that the messages and the ideas that were presented in this webinar look to be very much in tune to what the Italian presidency is now actually working on. I also particularly appreciate the informal character of this meeting compared to some very formal and a bit abstract meetings that we are used to. And I hope that this community of speakers will meet again, of course, hopefully in person. And that these ideas that have been flagged will be further developed and will be exchanged among us. I think I will make sure that they are disseminated among the participants and that we continue to have this dialogue, very constructive dialogue that we had. So thank you to everybody and looking forward to meeting